Welcome to the NWR Resources Virtual Resources Series. My name is Kerry Stevenson, and next up we have Lotus Resources. ASX code is LOT. Now, for those of you that were really smart 6 months ago, if you'd invested in LOT, you'd be up 140%. And if you'd been a little bit slow off the mark and you invested a month ago, you'd still be up 24%. So they've had a fantastic ride in their share price. And they're only just getting started. They've got the Kayelekera project in Malawi. Here to tell us all about it is their managing director, Keith Bowes. Keith, great to see you. Very exciting news for you over the last little while. And let's talk about what's going on over in Malawi.
Yeah, no, thanks very much, Kerry. Yeah, it's been a fantastic couple of weeks for us. As you've said, we've had a really nice run in our share price. And I think, well, I hope that's something to do with some of the work that we've been doing, but I obviously have to also put some of it onto what we're seeing in the spot price as well at the same time. So yeah, let me get into the project then. I'll talk a little bit about what we've got and what we're planning on doing in the future, and then happy to take some questions at the end of it as well. So as you mentioned, Lotus Resources owns the Kayelekera uranium asset, which is located in Malawi in Central Africa. The company acquired the asset of Paladin Energy in March of last year. So we've owned the asset for about 18 months or so at the moment. Just with what was it about Kayelekera that Lotus, and specifically the management team behind Lotus, liked about Kayelekera was a couple of points probably we can point to. First of all, is we recognize that Kayelekera is a proven uranium producer. So it operated between 2009 and 2014. And in that period, it produced about 11 million pounds of uranium, all of which was accepted by the conversion facilities at Orano, Converdyn, and at Cameco as well. So we see that as a positive when we go out and start to negotiate some of our contracts, because the material is known in the industry. The second point that we noted as well is that Paladin spent about $200 million on building the plant and putting in the various pieces of infrastructure. In our strategy going forward, we have no intention of increasing the production rate. So the existing nameplate capacity of 3 million pounds is more than enough for what we plan on doing with the project. And what that means for us is when we restart the asset back up again, it's a relatively low capital cost for us to start it back up again. The dollars we need to spend are effectively on refurbishing the plant. And based on our scoping study, we expect that cost to be around $50 million US. The other thing we recognize, and it's our opinion, is that if we are in the start of a new uranium cycle, which are the companies that are most likely to benefit in this new uranium cycle? Well, in our belief, it's the companies that have assets that are currently on care and maintenance. Those are the ones that can quickly start back up again and take advantage of the new uranium cycle. And Kayelekera fits that bill as well. The other thing we recognize as well, there's still some exploration upside. So we have an existing resource of about 37.5 million pounds, but there hasn't been a lot of exploration done on site or on any of the exploration licenses in the last 15 to 20 years or so. So we've done a review of the historical databases, and we believe there are some interesting targets there that we can drill out. And we actually commenced a drilling program, a 5,000 meter RC drilling program about 2 months ago or so, which has been focused on the periphery of the existing Kayelekera resources, looking at extending that out past the current pit shells. And then also, just as a final point as well, and I'll touch on it on one of the future slides, we've also made a rare earth discovery as well. That's just to the north of our existing pit. It's got some really interesting potential, and we think that can add value to the company as well. And then just as a final point, we are in a very strong cash position at the moment as well. As of the end of the June quarter, we have approximately $28 million in the bank as well, which is sufficient to see us through until the end of next year. I just want to really quickly touch on the market side, on the thematics of the uranium stuff. I don't want to spend too much time on this, but really just to talk about the points that we think are critical going forward. So we look at the short term, the medium term, and the long term catalysts. And obviously in the short term perspective, we're seeing the presence of Sprott having a huge impact on the uranium spot price. They came into the market in the middle of August when the price was around $32 per pound. It rose as high as $51 per pound. And today sitting around the $48, $49 per pound. So they've had a significant impact on that short-term price. But we also reckon there's a number of medium and longer term catalysts out there as well that are also going to be driving the uranium price, specifically the zero carbon future that everybody's talking about. We also recognize the electrification revolution and specifically electric vehicles that are coming on board, and also just the general trend in terms of the growth of electricity demand within the world as well. When we have a look at all that data and we have a look at what companies like WNA put out, we do recognize there is a significant imbalance in the supply and demand curve moving forward. And even under relatively conservative assumptions, the expectation is that there'll be a shortfall of uranium of about 30 million pounds in 2024, and that shortfall will grow to approximately 60 million pounds by 2028. And we've also seen with some of the conversations that we've been having with the utilities, a number of the utilities entered into long-term contracts in sort of 2009, 2010. The majority of those long-term contracts were about 10 years in length. So a lot of them are either in the process of coming off those contracts or already have come off those contracts. Now, I believe that when the utilities saw the spot price at around $32 per pound, I don't think they had any issue buying uranium on the spot price, at that spot price. But I think at the 48s, 49s, I don't think they're quite so happy to be buying on the spot market. And our expectation is that they'll want to re-enter into term contracts within the next few months. And then just as a final point as well, just to discuss the pricing at where it is at the moment. And I think this is a common theme coming out of most of the explorers and developers at the moment, that even though we are very, very excited about where the price is going, but probably the $47, $48 per pound price is currently still a little too low for us to be able to trigger a restart of any assets. We'll be looking for prices to be above the $50 mark for us to be able to make any decisions about restarting an asset back up again. I just want to quickly come back to this idea about which are the companies that are going to most likely benefit from the start of a new uranium cycle. And as I said, we believe those are the companies that have assets on care and maintenance at the moment. And if you have a look around the globe, there's probably 6 companies out there at the moment. Cameco, we've got the MacArthur River and Rabbit Lake. You've got Paladin with Langer Heinrich. You've got Lotus with the Kayelekera Resources. And it's interesting to note that Kayelekera is actually the 4th largest producing asset currently on care and maintenance. So our 3 million pounds puts us as the 4th largest out there. And then you've also got Energy Fuels, Boss Resources, and Peninsula, the other companies as well that are likely to be able to take advantage of this new cycle coming through. But when we have a look at this peer group, if we consider this to be our peer group, the one thing that really stands out to us is our market cap. We're sitting currently at about $240 million market cap. And if you compare that to our peers, Paladin at 1.7 billion, Energy Fuels at 1.1 billion, and even Boss Resources at $470 million, we still appear to be significantly undervalued compared to our peers. And therefore, we think there is still an opportunity for share price growth going forward. Just want to talk a little bit about the project itself now. So as we mentioned, it's a proven producer. It's produced 3 million pounds per annum before. It has all the infrastructure on site that's capable of treating somewhere between 1.4 and 1.5 million tons per annum. We also recognize that when the plant shut down in 2014, there have been a number of advancements in technologies and processes since then. And we believe the application of those technologies and processes will allow us to improve the project economics. We also have our licenses in place. So we already have our environmental license, and our mining license was approved for another 15 years about a month ago as well. There's still some permits that we need to get, but they're relatively simple for us to get. And then just as the last point, we still got some exploration upside as well. So the 37.5 million pounds that we currently have in resource, we see lots of potential to increase that as well. Just talk through the pathway that we see to recommencing production at Kayelekera. So we delivered a scoping study to the market in October of last year that set a really solid base case for us. Under the high grade scenario, we were seeing an 8-year life of mine producing on average 2.4 million pounds per annum with a C1 cost of around $33 per pound. So we set this really good base case with the scoping study, but really with the main benefit we got out of the scoping study was identifying what were the key cost drivers and the key value drivers for the project. And based on the work that we did, we have identified 4 areas that we think can add value to the project. They include ore sorting, which impacts on the grade being fed to the plant. We talk about power supply. The existing plant is powered by diesel gensets. We believe there's an opportunity to connect either to the national grid or to look at renewables or some other alternatives. We've also recognized that acid consumption and acid costs are one of the largest portions of our C1 costs. There's some technologies out there that we can implement that will allow us to recover acid and make better use of the acid we've got there. So we're looking at that as well. And then the last one is to do with tailings, and specifically its impact on sustaining capital. We have a tailings facility on site already, but there's only storage for probably about 4 to 5 years there, after which we would be required to build a new tailings dam. Now that's an expensive exercise for anyone to do. So we're looking at some alternatives to that, including in-pit disposal, which we think will be cheaper. Now, the idea then is we're using all of this work that we're doing now as a feeder into our feasibility study. We announced last month the commencement of our feasibility study, and we expect to be able to deliver the results of the feasibility study to the market in the middle of next year. I just want to quickly talk a little bit more about this ore sorting technology, because it is a very, very important part of our restart plans. It's not critical for us to have a profitable project. So what I mean by that is we're not using ore sorting to convert an uneconomic project into an economic project. What we're using ore sorting to do is to improve the economics of our project. And the way that we see that is in a couple of different areas that it can do for us. But let me just quickly talk through the results that we achieved. So we have done some test work at Steinhardt, which is a German company that's got some testing facilities here in Perth. We ran some of our run-of-mine material that was grading around 1,000 ppm through the ore sorting unit, and we were able to double that grade. So we could produce a product that had 2,000 ppm in it. Now, obviously, similar to flotation and other technologies like that, there is a grade recovery relationship. So when you're targeting that really aggressive upgrade in grade, your recoveries are relatively low. So they're talking 65% sort of recoveries for it. But if we're less aggressive on it and we say we want to go from 1,000 ppm to say 1,200 or 1,300 ppm, which is the sweet spot where we want to operate, the recoveries are greater than 90% in that scenario. So we're very happy with those results. Now, how we see ore sorting impacting the asset or impacting the project moving forward, we can use it to increase the average annual production. So as I mentioned in the scoping study, we were producing at about 2.4 million pounds per annum. By using ore sorting and taking the grade from 1,000 ppm to 1,200 or 1,300 ppm, we can achieve the nameplate throughput production of 3 million pounds per annum. But the option that I really like is there are a number of lower grade stockpiles that are currently on surface and will also be generated as we mine out the higher grade material from the pits. We've got about 9 million tons of this material that grades between about 350 and 450 ppm. If we were to take that material and put it through the ore sorting unit, we could produce a product or a concentrate that probably has 700 or 750 ppm grade in it, which becomes a highly economic feed for us to be able to put into the plant. So I think we can extend the life of mine by using ore sorting on these lower grade materials. And then at the same time, we also recognize that by increasing the grades and also rejecting some of the gangue minerals, there's an opportunity to reduce our operating costs as well. The other one I just want to quickly touch on as well is power, because that's an important part of our restart strategy as well. So as I mentioned, at the moment, the plant is powered off diesel gensets. We know power from diesel gensets is relatively expensive. It runs between about 28 and 32 US cents per kilowatt hour, depending on how much you're paying for diesel. It's also got significant greenhouse gas emissions as well. Now, power under the diesel option for us makes up about 15% of our C1 costs, and we're looking at some alternatives now. So we're in discussions with Eskom, which is the Malawian utility over there. We believe we can connect to the national grid at Karonga, which is the nearest town. It's about 30 kilometers away. But we do recognize that in Malawi, both the availability and the reliability of power is generally quite low. So we need to have some backups or alternatives to that as well. And we're identifying retrofitting a steam turbine onto our acid plants. We have an acid plant on site that, of course, generates a lot of heat. We can put a steam turbine on there and then recover energy from that steam turbine. And based on the calculations that Autotech has done for us, we believe we can recover somewhere between about 2 and 2.5 megawatts from that steam turbine, which is 25% of our power. That means theoretically we can get 25% of our power for $0 off the acid plant.
Nice.
We're also looking at options around solar and wind as well, so for the renewables, but we also recognize that we will still require some diesel genset backup as well. But having a look at this hybrid mix that we've got over here, we think we can halve our power costs. So instead of being that 28 to 32 US cents per kilowatt hour, we think we can get down to around 15 or 16 cents per kilowatt hour, which will have a significant impact on our operating costs moving forward as well. Just want to really quickly talk about the exploration potential as well. So as I mentioned, we commenced a 5,000 meter RC drill program about 2 months ago, which has been focused primarily on our brownfield exploration. So that's specifically around extending the existing mineralization envelope on the Kayelekera resource. So we've been busy working on that as well. I think you would have also picked up last week, we announced the acquisition of the Livingstonia tenements as well. So these are about 90 kilometers to the southeast of Kayelekera. It has a historic resource on it of 6 million pounds. We plan on taking our drill rigs after we've completed our drilling on site down to Livingstonia to look at some possible extensions around that Livingstonia resource, but also to do some QA/QC on it as well, with the intention that we'll be able to convert that resource into a JORC 2012 compliant resource as well. So quite a bit of stuff going around the exploration at the moment, just purely on the uranium. But as I mentioned, we've also got this rare earth opportunity as well that sits about 2 kilometers to the north of our existing pit. We did some work on it last year, saw some really high grade materials there. So we've decided to go back this year. We've done some more trenching. We're doing a little bit of drilling there as well to try and understand what the size of the footprint is, as well as the potential depth of the mineralization. And once we understand what that looks like, we'll then be able to decide what is the best way for us to get value out of this potential. Whether we try and look at developing something ourselves, whether we look at doing some JV with another company, or whether we spin it out into something else, we're not sure at the moment. But there's certainly something there that'll add value to the company. I'm going to really quickly touch on ESG. It is a very, very important part of the work that we're doing. And I think everyone who's involved in it or involved in environmental stuff at the moment, of course, recognizes zero carbon future and how important uranium is to that. And we want to be part of that conversation, talking to people about the importance of uranium and how safe uranium is as well compared to some of the other technologies out there as well. But of course, working in Africa, social is very, very important. Our social license to operate is absolutely critical for us, and we are starting to do a lot of work in the communities in terms of supporting them in various activities. We've also, as part of the new mining license that we got, we've entered into a community development agreement, which means when we start the asset back up again, 0.45% of our profits will be put back into the community to develop the projects that they want. And we've already started working with the communities to identify the various projects they would like us to work on as well. And then, of course, the governance issue, we're working hard around our governance issues, making sure of our compliance, both here in Australia, but also in Malawi as well. And then, Kerry, really just to summarize then, in terms of why we believe Lotus is well positioned for the next uranium cycle. Well, as I've said, a proven producer, produced 11 million pounds per annum that was accepted by all of the Western conversion and utilities out there, so it's a known product. We have strong cash reserves that will see us through into the end of 2023, so that'll cover our feasibility studies, our care and maintenance costs, our exploration work, and our overheads as well. We believe that we're still got some valuation upside to come. When you compare us versus our peers, we still have a relatively small market cap, but we also believe that all the work we're doing around our studies and exploration work as well will also add value to the company. And we have a strong board and management team in place that's got both African and uranium experience. And as I said, we already have the majority of the existing infrastructure on site. So our CapEx required to recommence production is relatively low. If you look at the scoping study, we spoke about $50 million. If you compare that to our current market cap, which last week was 240 US million, it's gone up a little bit since then. We think raising that amount of capital is going to be a relatively simple operation for us. So we don't see any issues with that at all. So I'm happy to take any questions, Kerry.
Keith, thank you very much. And that was a really good update about the project, which Kayelekera. Sometimes I don't get it right. If you'd like to ask a question of Keith, please put it in the Q&A panel at the bottom, and I promise I will get that question to him. In the meantime, I'll start to ask the question. Look, the uranium market is a little bit on fire at the moment, and you've given us a really good presentation there, Keith. What I guess I'd like to know is, what attracted you to this project? Is it because it's quick to start up and you can see how you can deliver value to shareholders?
I think that was one of the key things. We saw that the potential to be able to enter into the next cycle was really important. The group that I'm involved in has been a uranium bull for a number of years now, and I think we've recognized that there was a new uranium cycle coming, and which were the companies that will be able to benefit from that. But as I've said, it's the companies that have got assets on care and maintenance at the moment, and that's what attracted us to Kayelekera. Obviously, because it's a past producer, it has produced at nameplate capacity, and we believe we can bring it back online fairly easily as well. As you might pick up from my accent, I'm from Africa as well, so I'm quite happy working in Africa. I have no worries about working in Africa. So maybe some people have got some concerns about that, but I certainly have no issue with working in Africa.
Keith, what can you just summarize for us? You know, it's an investor audience that will be watching this. And from an investor's point of view, what's the news flow that you see from, let's just take it to the end of this year. Is there going to be a lot of news flow coming up? What are you working on now? And what do you think are going to be the value uplifts from a shareholder perspective?
So I mentioned these technical studies that we've been doing, the AllSorting, the power and all that, and those asset things. So we've done the bulk of that work, and we've got a really good sense of where we're going to land on that. Hence why we were quite happy to kick off the feasibility study. But I think there's still some results out of that technical studies that'll come out. We're talking about a phase 3 of the AllSorting test work, which hopefully we'll be able to get done this year. So we'll be able to report on that. We're getting almost to the end of the final version of what we're going to look for in the power hybrid assessment, let's say. So we'll probably be able to report on what we think our potential power costs could be for the site. I think by the end of the year or maybe early next year, we'll give a little bit of an update on how we're progressing with the feasibility study, just talking about the work that we've done and the targets that we still have moving ahead. So we've got that side from the technical perspective, but of course we've got the exploration work as well. So we'll have the results coming out of our uranium exploration. So that's the stuff that we're doing on our existing ML. We'll, I think, be able to present the results from the rare earth exploration as well. And then I think we'll be able to talk about the commencement of the exploration work at Livingstonia, but I don't think we'll see any results from that until next year, I don't think. But really the target over the next, say, 6 to 9 months is really the delivery of the feasibility study by the middle of next year. That is our primary focus at the moment. We want to get through that because we believe when we have the feasibility out there, it's going to be a lot easier for us to go and talk to the various utilities about getting contracts, but also talking to banks and investors about raising the capital required for the restart as well.
Which is not a lot. You said the capex was 50 mil. I bet they're going to be jumping all over you. Got a couple of questions coming up here, Keith, and I'm conscious of time. How does Lotus plan to deal with working in a third world country? Well, Malawi is pretty advanced, but especially trying to find skilled labor.
It is it's an important point, and it's something that we have recognized, and we've already started the process. So we do know that we are going to have quite a large expat contingent. We've taken that as a given. We know that when Paladin operated the asset, they did have a large expat contingent. We've recognized that, and we know we're going to have to go and get an expat contingent. But there are skilled workforces in Malawi. So you had all the previous operators that worked at the site, and as part of their retrenchment package, they've been given the first right of refusal for jobs when they come back up again. So we're hoping that certainly a core of people will be able to get back that were previous operators on the plant. So that's a really good thing. As I said, we'll be bringing in expats as well. But one of the things we're thinking about is we recognize that in order for us to refurbish the plant and all that, it's sort of a 12 to 15 month period for that. We think we're going to take advantage of that by going through a really comprehensive recruitment, training, testing phase as well. So we might end up setting up training facilities in, say, Lilongwe or Blantyre, which are the two main cities in Malawi and where we expect to get most of the labor from, and actually push the guys through some kind of training stuff such that when they arrive on site, they're not brand new, they do understand what things are required. So we have put a number of dollars in that $50 million aside for recruitment and training, because we do recognize that it's been really important.
Okay, we're almost out of time. I've got to ask this next question. Why did Joe says, why does Keith think their share price and market cap has lagged the rest of the sector?
I think it's a really good question, and I get this asked all the time. So I have my 4 standard answers for this. I think it's Malawi is one of them. I don't think Malawi is particularly well known as a mining jurisdiction. I mean, obviously, if you had a uranium mine in Namibia, I think you'd be in a much better position from at least a knowledge area. So we need to work on that. Malawi, there's no problems working in Malawi. It's a democratic republic. It's got good legal, good law and all that stuff. Low violence, petty crimes, the only thing you have to worry about. So I think it's educating the investors about Malawi being a good place to work. The other one, I think that when Kayelekera was held by Paladin, they focused more on their Langer Heinrich and spoke about that. So Kayelekera was always seen as the poor cousin and perhaps didn't get the news time that it deserved. Now it's sitting in Lotus. Obviously, we can talk about it a lot more. I do think there is a thought out in the industry that perhaps Kayelekera is an expensive operation. When you look through the historical data in the early years, 2009, 2010, yes, it was $50 per pound. But Paladin did a lot of work around optimizing the circuit. And by the time they shut down in 2014, they were operating at $35 per pound. And as I said in the presentation, I think there's some opportunities for us to improve on that even more. So I think there's that. And then the last one we're starting to pick up on as well is that we have I wouldn't say a small resource, but smaller than some of our peers out there at 37.5 million pounds. Maybe what is not recognized is we have a very high conversion of our resource into our reserves, where maybe some of the other companies don't have such a high conversion. And I think we should be measured on our reserves, not on our resources. And I think we'll get a much better rating if people were to look at that.
That was a really good summary, Keith. I really appreciate it. I'm sorry, Joe, we are out of, actually, Joe's just said, great answers, Keith. You truly understand the project, and he will continue to be a happy shareholder. And on that note, I will thank you for joining us on the NWR Virtual Resources Series, and see you soon, Keith. Great to see you on today's show.
Thanks very much, Kayra. It's good seeing you again as well.
Cheers, mate.
Cheers.